Hello, everybody. Welcome to Tuesday. The S&P 500 was down almost 0.8% today. Some of the same things that were driving the market down yesterday were kind of still there today. Just some concerns about the tariffs actually staying around long term, just in the sense that, I think a lot of market participants were hoping that the tariffs would be used to try to knock down trade barriers in other countries, and we kind of use that threat, and maybe we end up with a small tariff that still remains, but it's pretty small, versus where we're at now, or even half of where we're at now, which would be quite high and could be a real issue. So, for example, Canada, who's coming meeting with the president today, they have high tariffs on our dairy products coming into Canada. So maybe these tariffs that we're using, the negotiation allows us to lower those tariffs, right? And so that would be probably, I think, the best case scenario for these tariffs. But if we're going to keep them around, we're going to keep them at these higher levels, and we're going to look at them as an income stream and possibly an income stream to replace income taxes. Um, the market's not really ready for that as far as that goes. It might work, but the transition would probably be pretty rough to get there as far as that goes. So that's where the market is on that. Of course, the Federal Reserve is meeting today. They meet tomorrow. As I mentioned, they're not going to lower rates according to the market bets. But it will be important to see what they talk about, especially for what rate cuts we might have this summer in June and July, if any, and what they see happening as far as that goes. The Fed probably could lower some rates here. That would be a big surprise if they come out and do that yesterday. Tomorrow, sorry, the market would respond positively to that. They're usually a little bit late. But they're a little worried about what tariffs are going to do to prices, and they're not sure yet. They haven't seen that. I mean, what's kind of fascinating if you think about it, well, we're reliving the early 1900s here. We had the pandemic was in 1918. We had our pandemic here in 2020, and now we're talking about tariffs, which is what they talked about again in the 1930. So we're kind of going through this time frame. It's interesting that it's been basically 100 years apart. And so it's difficult. I remember during the pandemic, one of the things I talked about a lot is trying to look for precedents, what happened in the past. Well, 1918, it's very difficult to see. We're a little bit closer now. The last big tariffs that we had like this was 1930, although these tariffs are higher right now. And so you go back and study that, which I've been doing, all week and all weekend and ever since this thing started. How did this work? What happened? What did we learn from that? How do we make that better? And I'd say the thing that's really different that we have that's different now is this concept of kind of bailing things out. So 2008 is when we started that with the different bailout processes for the banks, the money that got sent out as straight up stimulus checks, the quantitative easing that the Reserve does, where they buy bonds on the open market. Um, all of these worked, and then we did it again in 2020. The problem we might have here is just the bond market itself has to be able to, absorb all of that new spending, and so we get that money by selling our bonds. And if we have a tax cut on the table already, or if we have already done a tax cut, can we do these types of stimulus things? Will the bond market, hold up during that period of time? As we're going. So, and that, was what caused the pause back in April, the bond market, having troubles just because of the severity and the size of those potential tariffs that were there. So, but if we use those tools, if we're able to use those tools, we have a chance to recover from something if it does happen quite quickly. But let's keep in mind that nothing has to happen here. Things could change very rapidly. We are already looking at some type of a gap in supplies. We have, 60% less ships leaving China for the US, that type of thing. So we are going to see shortages, probably some higher prices. But if that's combined with some, fairly immediate resolutions on some of these trade barriers, especially with China, then we're just going to have a kind of what we'll look at as a temporary gap, and the retail stores won't lay people off. The trucking companies probably won't lay people off for temporary, the different ports that, might lay people off if they see it as a longer term thing. So we're in this window right now where they do need to move along fairly quickly to try to, give some good news so that these companies don't start the layoffs. Because once you start layoffs, it can be a cycling thing that gets to be a problem. These people that are laid off no longer can, afford as much. And so that means other people get laid off because they're not spending money, and you kind of end up in this cycle. which is what happened in the last tariff, regime. The unemployment rate went from 6%. They were trying to lower that by putting tariffs and making more government pieces, more things made here in the U.S. What they didn't count on was all the counter tariffs that were pushed onto the U.S. from exports. And then, you get a boycott scenario also, which is what's happening now. You hear about McDonald's talking about international sales are down and such. And so tariffs are tough on this particular environment. You have to handle it just right, in my opinion, to make it work. They haven't worked in the past at this level. So hopefully we can figure out either how to lower this level or how to figure out how to do it. So I think if we keep at these levels, though, we'll have a tough transition. And that's why, we are being pretty conservative right now, just wanting to see where things are going to go. So anyway, look forward to being able to talk to you tomorrow. Thank you very much.